Gold is above $5,000 an ounce. Bitcoin is dominating the headlines again. AI stocks are trading at valuations that make the dot-com bubble look like a warm-up act. Every asset that was supposed to run has already run. Every crowded trade is already crowded. Every mainstream thesis has already been picked clean by the time most retail investors even heard about it. Except one. There's one asset sitting right in front of every investor in the world right now, priced at $79 an ounce, that JP Morgan has quietly put at the top of their commodity conviction list for 2026. One asset that just closed the single largest streaming transaction in the history of precious metals. One asset the world has consumed more of than it has produced for 6 consecutive years, drawing down over 762 million ounces from global reserves just to bridge the gap. One asset sitting at the intersection of the 3 biggest investment megatrends of the modern era, the green energy revolution, the electric vehicle transition, and the artificial intelligence buildout. That asset is silver. And before you close this tab and tell yourself you already know the silver story, I want you to stay with me, because I promise you, you do not know this version of it. This is not about dollar collapse theories or inflation hedges or stacking coins in a bunker. This is about a structural supply crisis that is already 6 years deep and accelerating. It is about industrial demand curves that are growing faster than the market has priced in. It is about a ratio signal that Wall Street traders have used for decades to time major entries into silver. And that signal is flashing again right now, in the same direction it has flashed before every significant silver surge in modern history. My name is not important. What is important is that by the time this video ends, you are going to understand exactly why the smartest institutional money in the world is quietly positioning in silver while everyone else is still chasing assets that have already made their biggest moves. This is recession warnings. Let's get into it. Let's start with the big picture because context is everything here. Gold just hit an all-time high above $5,000 per ounce. Bitcoin completed another massive cycle. The stock market has been held up largely by AI euphoria, with technology valuations stretched beyond what any rational earnings model can comfortably justify. Investors everywhere are hunting for the next trade, the next asset that has not already run, the next opportunity before the crowd arrives and prices out the upside. And yet silver is sitting right around $79 an ounce. After briefly touching $120 in January of 2026, its highest nominal price in history, silver pulled back sharply. And to most people, it barely registers as a conversation worth having. Your coworkers are not talking about it at lunch. CNBC is not running special segments on it. The financial media that spent months breathlessly covering every tick in Bitcoin and every AI earnings beat has largely moved on from silver as though the story is over. Here is what decades of market history will teach you if you pay close enough attention. That is precisely the environment where the most asymmetric opportunities live. Not in the assets that are on every financial news ticker, not in the trades that everyone at the office is already making. The real money, the generational money, gets positioned in the gap between where fundamentals actually are and where mainstream attention has not yet arrived. The question that matters is not whether silver sounds exciting right now. The question is whether the fundamentals actually support the thesis, or whether this is just noise dressed up in dramatic music and selective data. That is what this video is built to answer, and the answer is going to surprise you. Before we go any further, drop a comment right now and tell me where you are watching from. There's a number that serious precious metals traders watch more closely than almost any other indicator in this market. It has a track record stretching back through decades of market history. Every time it has reached a certain extreme and then reversed, silver has outperformed virtually every other asset class during the reversion. That number is called the gold to silver ratio. The math is simple. Take the current price of gold, divide it by the current price of silver, and the result tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, that number sits in the low to mid 70s, meaning it currently takes roughly 72 or 73 ounces of silver to purchase a single ounce of gold. That sounds like a piece of trivia. It is not, because the historical average of that ratio, going all the way back through recorded financial markets, has been somewhere between 50 and 65 to 1. That is the equilibrium. That is what the market has, across long stretches of time and across radically different economic environments, considered a fair and natural relationship between these two metals. When the ratio drifts significantly above that range, it is a quantitative signal that silver is undervalued relative to gold. When it falls far below, the signal reverses. Traders and institutional precious metals desks have used this ratio for generations to identify entry points, shift allocations between the metals, and time mean reversion trades. And right now, with the ratio sitting in the low to mid 70s against a historical average of 50 to 65, silver is still mathematically cheap relative to gold, even after everything that happened in 2025. To understand why that matters so much right now, let me take you back exactly 1 year. In April of 2025, the gold to silver ratio hit 105 to 1, 105. It would have taken 105 ounces of silver to purchase a single ounce of gold. That was one of the most extreme readings in modern financial history. Analysts who track this market called it openly a once-in-a-generation signal. The historical precedent was unambiguous. Every single time the ratio had spiked to that level in the past, silver had subsequently outperformed gold by a significant margin as the ratio reverted toward its long-run average. That is exactly what played out. From April of 2025 through early 2026, the ratio compressed from 105 all the way down to approximately 57 to 1. During that same window, silver gained roughly 147%. Gold advanced approximately 67% over the same period. Silver nearly doubled gold's performance during that compression phase. It broke above $100 per ounce for the first time in history, briefly reaching $121.64 in January of 2026, a nominal all-time high. Now here's the question this entire video is built around. With the ratio now sitting back in the low to mid-70s, and with the historical average still at 50 to 65, silver remains above that equilibrium. It is still elevated. It is still, by ratio math, undervalued relative to gold. One analyst from the Gabelli Gold Fund made the arithmetic explicit in a recent interview. If the gold to silver ratio drops to its historical floor of 30 to 1, a level that has been reached before, and gold stays anywhere near $5,000 per ounce, silver would need to trade at $170 just to match that reading. $170 from $79 today. That is more than a double from current prices, just to reach a level the market has already seen. The ratio is not a guarantee. It is a directional signal. But the direction it is pointing, and the historical track record of what happens when it reverts from elevated levels, is one of the clearest setups silver has offered investors in years. But here's the thing. The gold to silver ratio is the headline. It is what gets people's attention. The actual story, the reason this setup is different from previous silver cycles, is what is happening underneath the ratio. And when you start pulling that thread, what you find is a supply and demand picture unlike anything the silver market has produced in modern history. Silver is now entering its sixth consecutive year of global supply deficit in 2026, 6 years in a row. And I want to be precise about what that means, because it is not an abstraction. A supply deficit means the world is physically consuming more silver every single year than it is producing. Every year. And every year, that gap has been bridged by drawing down existing above-ground stockpiles, reserves that were built up over decades and are now being systematically depleted. Since 2021 alone, the world has consumed 762 million troy ounces more silver than it has produced. 762 million ounces drawn from reserves that are not being replenished. That is not a temporary imbalance. That is a structural drain on a finite resource. And here's the supply-side reality that changes everything. Over 70% of all silver produced globally every single year comes out of the ground as a byproduct of mining for other metals, primarily copper, zinc, and lead. Silver is not the primary target. It is what comes along for the ride when miners go after something else. That means silver production is not controlled by the silver price. It is driven by copper economics, by zinc demand, by what the market for base metals is doing. A silver price of $80 an ounce does not automatically trigger more silver supply if the copper price does not justify expanding the mine. You cannot flip a switch and produce more silver the way you can with most commodities. The leverage is simply not there. And on top of that structural constraint, ore grades at existing mines are declining, meaning miners are processing more rock to get fewer ounces. New silver-focused mines, when they do get developed, take well over a decade from discovery to first production. Once you factor in exploration, environmental review, permitting, financing, and construction. Recycling from industrial applications is technically and economically limited, especially for silver embedded in solar panels, electronics, and medical devices, where recovery at scale is not feasible with current technology. The Silver Institute has projected that if current demand trajectories continue, the annual supply deficit could reach 200 million ounces by 2030. 200 million ounces every single year, with no supply capable of filling it. That is not a short-term imbalance. That is a structural crisis building in slow motion. And the demand side of this equation is not cooling down. It is heating up in ways that most investors have not begun to price in. Here is what JP Morgan's commodity research desk understood when they placed silver at the top of their conviction list for 2026. And it's the same reality institutions locking in multi-billion-dollar streaming deals already see clearly. Silver is no longer just a passive store of value or a legacy inflation hedge sitting untouched in vaults. In today's global economy, it has transformed into one of the most critical industrial inputs on Earth, deeply embedded in the three dominant investment megatrends of this era: The global transition to green energy, the acceleration of electric vehicles, and the explosive buildout of artificial intelligence infrastructure. These forces are not speculative narratives. They're active, scaling systems that are consuming silver at an unprecedented rate. Unlike gold, where only a small fraction of demand is industrial, silver is fundamentally different, with roughly 60% of annual consumption going directly into industrial applications. Once used, it is rarely recovered in meaningful quantities. It doesn't cycle back into supply. It disappears, and that disappearance is accelerating year after year. Nowhere is this more visible than in solar energy, where silver's role is not optional but essential. It is the most electrically conductive metal on the planet, and in photovoltaic cells, that property directly determines efficiency. The silver paste inside each panel is what captures and transfers the electricity generated by sunlight, and even marginal improvements in efficiency translate into massive financial gains at scale. For over a decade, engineers have tried to find viable substitutes, but nothing replicates silver's performance under real operating conditions. This is why solar demand for silver has surged from around 11% of global industrial use in 2014 to nearly 30% by 2024. And the expansion is far from over. Governments and private sectors worldwide are pushing aggressive solar capacity targets, with hundreds of gigawatts being added annually. At the same time, newer, higher efficiency panel technologies are increasing the amount of silver required per unit, rather than reducing it. The world is not only installing more solar panels in Widersto, it is embedding more silver into each one. That creates a compounding demand effect that supply simply cannot match. While some attempts at substitution exist, they remain limited due to cost, durability, and efficiency constraints. Even conservative projections suggest solar alone could consume well over 100 million ounces annually in the near term, placing continuous strain on available supply. Layer on top of that the electric vehicle revolution, which adds another structural demand channel that did not exist at scale just a decade ago. Every electric vehicle requires significantly more silver than traditional combustion engine cars, used across electrical systems, sensors, battery controls, and safety mechanisms. With global EV production now measured in the tens of millions annually, this translates into tens of millions of ounces of additional silver demand each year. And that figure only reflects the vehicles themselves. The infrastructure required to support them, charging networks, smart grids, and energy management systems, adds another layer of consumption. This is not a future projection anymore. It is happening right now across major economies, turning each new vehicle into a permanent withdrawal from the global silver pool. Then there is artificial intelligence, the least discussed yet potentially most powerful driver of all. AI data centers are expanding at an extraordinary pace, requiring immense amounts of energy delivered with maximum efficiency and minimal loss. Silver's conductivity makes it indispensable in high-performance electrical systems, connectors, and power distribution components within these facilities. As global data center capacity scales to meet AI demand, the need for silver scales with it. Even modest adoption of silver-enhanced components across this infrastructure could add a significant percentage increase to global demand over the coming decade. Beyond that, the continued rollout of 5G networks and advanced consumer electronics introduces another steady drain. Every base station, every upgraded smartphone, every connected device incrementally increases silver consumption. When you combine all of these trends, the imbalance becomes clear. Supply is growing slowly, while demand is accelerating across multiple independent sectors at once. At this point, it's worth stepping back and recognizing that none of this is fringe analysis. These are the same fundamentals being acknowledged by major financial institutions and reflected in their positioning. Large-scale forecasts are increasingly pointing toward higher silver prices driven by industrial demand and constrained supply. Governments are beginning to treat silver as a strategic material, and policy decisions, such as export restrictions, are tightening the global market further. Meanwhile, major mining and streaming deals worth billions of dollars are being executed to secure long-term access to silver production. That kind of capital commitment does not happen without strong conviction in future value. Despite all of this, there is still a common perception that silver has already made its move, that the opportunity has passed after its recent surge and pullback. But that interpretation misses the core dynamic. The structural drivers behind that rally have not disappeared. The supply deficit remains unresolved, demand continues to grow, and the inventory drawn down over recent years has not been replenished. What exists now is a tighter market with less buffer and greater sensitivity to any new catalyst. Whether that catalyst comes from macroeconomic shifts, policy changes, supply disruptions, or renewed investor interest, the conditions are already in place for a significant move. The system is not resetting, it is compressing. Understanding the thesis is one thing, but translating it into action is another. Investors typically approach silver through a few primary channels, each with its own trade-offs. Physical silver offers direct ownership without counterparty risk, but comes with storage and liquidity considerations. Exchange-traded funds provide easy access and liquidity, but represent a financial claim rather than the metal itself. Mining stocks introduce leverage to price movements, but also bring operational and geopolitical risks. Streaming and royalty companies offer exposure with reduced operational risk, sitting somewhere between physical ownership and mining equities. The right approach depends entirely on individual risk tolerance, time horizon, and portfolio strategy. When everything is put together, the picture becomes difficult to ignore. Silver's historical role as money still matters, but its modern identity as a critical industrial resource is what is driving the current cycle. It is embedded in energy, transportation, technology, and infrastructure, the foundational systems of the global economy. Supply is constrained by geological and economic realities that cannot be quickly changed, while demand is expanding across multiple high-growth sectors simultaneously. The result is a persistent deficit that continues to draw down available reserves. Institutional capital is moving accordingly, securing supply and positioning for long-term appreciation, while much of the broader market has yet to fully price in these dynamics. That gap between fundamentals and market perception is where opportunity tends to exist. Timing is always uncertain, and no outcome is guaranteed, but the underlying conditions are clear. The forces driving silver demand are not temporary trends. They are structural shifts shaping the next decade. And while attention often flows toward assets that have already made their biggest moves, the more important question is what happens to the one that hasn't fully caught up yet.